Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar. Before we get started, let's take a look at the shared disclaimer and be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show and webinars, like all our show and webinars, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and we will welcome Dimitri Pargamonik to this stage, and he's going to talk about how to set up and analyze a calendar spread for an options trading strategy. With that, welcome, Dimitri.
Good morning, Will. How are you?
Awesome. Let me bring your screen to the front. It's on now.
Yep. And today what we'll do is set up a calendar spread and just review some of the risks, outlook, potential returns, maybe how to run a valuation on a calendar spread and change some assumptions to see how that impacts the value of the spread. And to do that, we have to set up a calendar spread. And let's maybe take a look at something that already traded out there, and we'll analyze that calendar spread that already, somewhere yesterday, we're not open today, but we'll take a look at yesterday's trades, find a calendar spread, and we'll set that up and analyze it. And to do that, I'm going to go up here under screeners, and we're going to hit on, under screeners, multi-leg. Why is this not? Sorry. One second.
No worries.
So we're going to go to the multi-leg options trade screener over here. And this screener lists the different multi-leg trades that we detected yesterday. I'm going to go and select spread type calendar spread. So we're going to take a look at, let's take a look at call calendar spreads. Select that. And we see there are 387 of those we detected yesterday. These are sorted by highest volume. And I'm just going to, this first one, FXI, had some stop tied to it. But let's come down to maybe TLT over here. So this is a ETF. If you click on it, you'll get some more information on it. It's the iShares bond ETF. And going across from left to right, we see there's 6,000 contracts involved in the call calendar spread. It was the June 20th, August 15th, 93 call spread. Okay, so it's a time spread, 2 different expirations on the 93 strike calls. One expiration expires in 38 days, one in 94. So if you click on this arrow, it will take you to the options chain and let you set up this spread so we could analyze it further. But I'm going to just go to TLT and set it up just so you could walk through if you wanted to set it up yourself or set up a similar spread. So I'm going to click on TLT. And we come to this page. We want to go to the options chain on the left-hand side. We're going to click option chain. And I'm going to close this menu to expand our screen. And first, we want to go to the June 20th expiration, because this was the June 20th, August 15th. So on the June 20th, we were looking at the 93 call. So for this spread, we're going to analyze it maybe from the long side. Okay. Selling the June 20th call buying the August 15th, and you could analyze it in reverse, but we need to pick a side. So let's start out with the first leg. We're going to sell the June 93 call. So we're going to click on this bid. And when it clicks on a bid, it sets up this ticket or leg from the sell side, selling the June 20th 93 call for 16 cents. We could change these price. We could change, all these, but let's keep it as is, and we'll keep the 16 cents because that was the current bid on that call. Then let's go to the August 15th expiration. We're going to click on that. And now we're going to find the 93. Let's come up here. We're going to find that 93 call. And you can see here, it's 65 cents, 66 cents. We're going to click on the offer this time, the 66. Click on that. And now we have the second leg of the spread. And you could see the second leg buying the August 15th 93 call for 66 cents. And we're going to run the analysis on the current markets and see what the spread looks like. Where do we value it from a historical perspective, and the potential payout. So I'm going to run this analysis, and then we get all these analytics. So here, this looks at theoretical values and tries to value the spread based on different methodologies. Okay, just like any financial instrument or investment, when you're looking at the market prices, you're trying to create some benchmark or some valuation to see where the market prices are versus your theoretical values and how much they diverge. Okay, so in stocks, you might try to price out future cash flows or earnings and discount them. In a real estate property, you're going to try to forecast your potential rent minus your expenses and create a value that way. And this looks at the historical values and tries to put a value on these options. One is looking at historical stock returns and distributions based on how the stock moved historically. And this one looks at the implied volatility of similar options. And here we see that if we took the average value of similar options, we have a value of 47 cents, which is very close to where the market is, right? The market is 50 cents. So that's very close to where really it usually is. Here's the market, 48 cents, 50 cents. So that's really, we could say, like in the historical range. You're never going to get exact stuff to the penny. These are based on estimates. The median price is 45 cents, and this is the historical range, 28 cents, 82 cents. So it's like right in the median price. So let's say it's in line with the historical averages. Then let's slide down here. These are the risk sensitivities of this spread. So we could see it has a little bit of a delta, means it has a bias towards the upside. A positive delta means the spread will make if the stock goes up, and it will lose if the stock goes down. It has a positive gamma, positive vega. So your vega is positive because you're long the longer dated option that has a higher vega than the shorter dated option. You have negative theta and positive rho. So we'll look at this a little bit more once we come to a different tool once I leave this page. If we slide down here, this is the price chart on the day. And up here, this is tracking the price of that spread based on mark-to-market prices. So mark-to-market is the option values are changing throughout the day, even when there's no trading, right? So the option values will go up and down. If the stock price is going up and down, the values will go up and down. They don't, even if the option themselves don't trade, they're gonna, the bids and offers will move, move based on implied volatilities, decay, the stock moving. So this is tracking those markets. The yellow is telling us the midpoint, and then you have these other two dotted lines which track the offer price and bid price. So we know where the markets are pricing these or pricing the strategies by observing the posted bids and offers. Okay, and here we do see that it traded at 143.07, 6,000 contracts for 46 cents. Okay, with at the time the bid was 46 cents, 49 cents in this spread. So this is looking at the spread, and the stock was at 85.66. And here we get this payout diagram. It's to give us an idea of what the potential payoff will be at the expiration here on June 20th. And it's looking at June 20th because we have two expirations. We have June 20th, and then we have this August 15th. However, when we come to June 20th expiration, this strategy, right, as a call spread will cease to exist as a call spread. So on June 20th, either the June 20th option will expire worthless and go away, and then you just have the August 15th option. So then your strategy is just long a call. Or if it's in the money, your short option gets, if you do nothing, gets converted to stock, and then you have a call in a stock, which is a different strategy. It's no longer a calendar spread. So on June 20th, we try to draw what this potential payoff will be. Another issue with a calendar spread is that one option will be easier to determine at different stock prices, if it will be profitable or unprofitable, because it's either going to be out of the money or in the money. So we could figure out the value of that option because it goes to parity. But the August 15th call, that's going to have time premium, and that's going to be based on the implied the implied volatility level will determine how high or low that option will be. If the implied volatility goes down, it'll be priced lower. If implied volatility goes up, it'll be priced higher. But we don't know what the implied volatility of this option, of August 15th option, will be at expiration, at that expiration. Okay, so this one right now is by default just using the current implied volatility. Okay, if there's no change in the implied volatility. And what we see here is that if the stock price is right here, this line, current price, 85.86, this has, with nothing else, changing, this has a bullish bias. So you want the stock to float up to 93, right? That's your sweet spot. And the reason for that is that your short option will expire worthless. So whatever you sold it for, well, you will receive that. You keep that credit. And your long option, well, if the stock is right at the money, that's where your time premium is the highest, right? So it's all time premium at that point. So that's your sweet spot. 93. And so we could see here that from the long side, or if the buyer, their outlook or their, to maximize the value of that spread, you want the stock to float higher, and you want it to hit that 93 at expiration. So that would be the outlook on this strategy from this setup. Buying August 15th, selling to June 20th. Now, if you reverse it, here we could reverse this strategy. If I run it, right now, it'll look different, right? You want it to move away from the 93, and moving down is better. Let me see if I could give it 3 standard deviations, or move all the way up here. So you want it to move away from that 93. Let's do 20% range. So you could see from the short side. Okay, and the reason for that is, well, you would be receiving a credit, right, for selling it. And if the more the stock moves away from this strike 93, right, the more it moves away, both options go to parity, right? So either they're both going to be going to 0, or they're both in the money in one delta, and there's no premium. They're both just either 0 or they're worth their intrinsic value. Like, let's say this, if the stock goes to 1,000, well, it's all intrinsic. At that point, they're going to be all completely in the money. So that's why from this side, you want it to move away in either direction, away from that strike. Okay. So let's come to another tool that could help us maybe change the parameters. So let me go back to our original. I'm going to swap this, buy and sell. So we're going to go back to buying the August 15th, selling the June 20th. Click on this. Now we swap the actions, run the analysis. Now we're back to our original setup. And let's go to the pricing of risk and sensitivity. And here we have the legs, the strategy legs. Selling the June 20th, 93 call, buying the August 15th, 93 call. We have the days to expiration, then the current implied volatility of each leg, and the interest rate that we're using on each leg. And here we see that the strategy price is 50 cents. And these are the delta, gamma, beta, theta, rho. And if we wanted to see a chart of what this looks like if nothing else changes, and at the end of the day, just the stock moves, right? So the implied volatility is the same, and the stock moves, we could see that to the downside, you're losing, you have a positive delta, and to the upside, you're making. So, it's up 1%, 2%, 3%. This is your expected gain or loss from your original price. So now we're kind of get a sense of the risk of this strategy, and let's test out the sensitivities of the strategy. Okay, let's say we're interested to see the impact of this strategy as time goes on. Okay, so what is the time decay? If we leave everything else the same, the implied volatilities, and we just move forward from 38 days, let's say, with 29 days left. So I'm moving to, what would this look like on May 22nd? So I'm going to click this, May 22nd, and you could see now I'm subtracting 9 days, right? Moving 9 days forward. and keeping everything the same, run a comparison. Okay, so a couple things here. We see that on May 22nd, everything else the same. The value of the strategy decreased by 3 cents. The delta increased, the gamma increased, the vega increased, and the theta increased. So we could compare the original line to the new blue line. And what we see is to the upside, it's gaining faster. To the downside, it's losing faster. Okay, so as time goes on, right, this is the impact that the value of this strategy decreased. Let's move forward a little bit more. 16 days. So you could see the impact, right? So you really need this to move higher. Okay. Now, what if we change the assumption and said, well, the real reason we got into this spread in the first place is because we think that the implied volatilities will increase. We're long vega. So let's increase the implied volatility of both. Let's say we think that really both of these implied volatilities will go to, let's just enter in 20. I'm going to enter in 20 here, and I'm going to enter in 20 here, right? So now we increased it by 3.1 vol clicks and 3.9 vol clicks. Let's run that analysis. So now we see a different story. We're long vega. Remember, we're long vega originally. So now this strategy went from 50 cents to 77 cents. So you could see across the board, look at that blue line, right? That offset the decay. So you could see here that now we're gaining much faster. We're gaining even to the downside. We're break even. We're gaining even a 1% downside move. We're still gaining because that delta that we lost on was offset by the implied volatility increase. If we go down even 2%, we're almost break even. So that vega, if our vega or if our implied volatility forecast or outlook was that it's going to increase to 20, and we're right, well, now we see a different risk, potential reward versus the risk. What if we're wrong? What if 16, even though maybe it's on the low end, 16, let's say it's on the low end, but it could still fall lower. What if it goes to 14? Maybe we're wrong and it goes down even more. So let's see what that looks like. What if they both go to 14? Run that analysis. So you can see now I'm decreasing both implied vols and moving forward. All right, 22 days. Run that analysis. Now you see we're down. We went from 50 cents originally now to 27 cents. Right now, you could see the losses got greater on the downside, even to the upside, a 1% gain in the stock. So we have a positive delta, which is good, but the decay and implied volatility move down was greater to the point where now we're at a $13 loss. So we need at least a 2% gain in the next 22 days before expiration. Next 22 days, we need at least a 2% gain to offset the decay and a implied volatility decline of around 2. So these are ways to look at a calendar spread and start to test out the sensitivities, run your analysis to see, well, what if scenarios? What if my outlook is correct, what do I stand to make, or lose? What if I'm incorrect, and what do I think what do I think the downside is in the implied volatility and in the decay? And what do I stand to gain or lose there? And does this fit into my outlook? And is the risk reward worth it to me? And does it fit into my overall, risk portfolio as well? So, Will, I'm going to stop right there. I think we gave a pretty good overview of this tool.
Yeah, that was great, Steve. Thanks for bringing that to the Chameleon community. For those who did not watch our webinar yesterday, we had a webinar with Interactive Brokers. You can go to their website and check it out. Just search for Market Chameleon in the contributors, and you'll find all the webinars we've done with Interactive Brokers. With that, D, another great show. Thanks for bringing it to the Chameleon community. Remember, everyone, like us, follow us, thumbs up on all the social platforms. Great job, D.
Thanks, everyone. Stay safe out there. Have a great trading day.
Trade in peace, Chameleons. Everyone have a great day. Bye.